Hello everyone, my name is Carlos Casanova. I'm Coface's Asia Pacific Economist. I'm based in Hong Kong, and I've been tasked with giving you the last presentation of the day. I'm sure you're all a little bit tired after listening to so many econ presentations. I know as well there's a big storm outside, so thank you so much for making it today, even despite the weather adversities. I will try to keep it short as we're a little bit overrun, but do feel free to interrupt or ask any questions at the end of my session. I'm open to, all questions are good and welcome, so just please feel free to ask questions if you have any. If we've discussed many things today, and I'm sure that a lot of you will go home and you might not remember a figure or a detail or a particular something that someone said. But if there is one image that I want to take back home with you today, it's this image of a pendulum. So we have seen an improvement in the global economy. In fact, this is an improvement that's been taking place over many months. The title of the slide is Gaining Momentum with a question mark. And that was the title of the first publication of the IMF this year, where they sort of saw an improvement in overall conditions, but they were not very sure, so it was not very assertive. The latest report is called A Firm Recovery. So there's definitely been an improvement in the rhetoric over the years. But this upswing in economic growth is, in our opinion, not sustainable for a series of factors. So we will talk you through what's led to this improvement in the tone of what you read in the press and what economists are talking about, and why that's not sustainable and why that might come down and hit a lot of the major economies, many of which are Singapore's key export partners. This includes China, which accounts for 25% of Singapore's total exports to the world, if you factor in Hong Kong into that equation. Malaysia, of course, being a neighbor, accounts for 11% of Singapore's exports to the world. Indonesia, 8%, the Eurozone, 8%, and the US, 7%. So without further ado, I'll dive into the details. The first thing I want to mention is this global economic recovery is highly synchronized amongst all of the major economies. And I have a slide on the US and the Eurozone, but I just want to highlight that we've seen a pickup in activity in the United States, in the Eurozone, and China. And these being large economies, of course, is translated into better economic growth. We do expect growth to pick up from 2.6% last year to 2.9% this year, which is quite a sizable an increase given that we're talking about the whole world, right? Moreover, this synchronization also has taken place for sectors. So we see an improvement amongst all of major economies, but also an improvement amongst a series of sectors. This chart shows a correlation between added value by sector and global GDP over a very long period of time, between 1980 and 2017. And you can see that some of the sectors that are more highly and positively correlated on the right-hand side of the chart are also sectors that are pro-cyclical. So they benefit when global conditions improve, and they deteriorate when global conditions worsen. On the left-hand side of the chart, we have sectors that are not pro-cyclical, and for example, things like education and healthcare, which the government tends to invest a little bit more on when the economy is not doing as well. So of course, a lot of the sectors that are pro-cyclical have benefited from cyclical tailwinds, meaning that for a series of factors that are not permanent, they've been doing better than expected this year. And so that throughout all of the economies in the world has translated into better momentum, but is not necessarily something which is sustainable, as we'll see in further slides in the following slides in this presentation. But it's undeniable that we have seen an improvement in global conditions, and that's translated into more upgrades than downgrades in our country risk assessments, as you can see in this beautiful map of the world that we have here. This is true for all of the major economies in the world, excluding some countries in GCC, in the Middle East, which have been afflicted by ongoing problems with lower oil prices and some political risks associated with lower fiscal revenues derived from those. Just to give you a little bit of context, we had a great presenter from Moody's earlier on. Our country risk assessments are different to sovereign risk assessments because we are not discussing sovereigns. We are not looking at the risk that a country like China would default on its sovereign debt. We go a little bit deeper into our analysis, and this is a measure of credit risk, so it's the likelihood that a company in a country, a company in one of these countries will default on its debt. How do we come up with these assessments? There are four main pillars that form this assessment. The first one is, of course, our macroeconomic forecasts, things like GDP and inflation. The second pillar is something that you will all be able to relate to, is the business climate. Sometimes just because a country rating is high or low doesn't mean that doing business in the country is easy or hard. So our business climate, which we also publish, includes things like the ease of doing business, how available data on a potential buyer in that country is. I'm sure you all have business in Vietnam and China, and sometimes accessing the right data for a company in those countries is not the easiest task in the world. So all of these will be reflected in the business climate, together with the legal framework in that climate. The third pillar is political risk. We've developed a proprietary political risk model that we now publish in conjunction with our country risk assessments. And it's a very comprehensive model that takes into account a variety of factors, most of the factors you can possibly imagine that are related or associated with political risk. And I won't go into all of them because it's quite comprehensive, but it includes things like the proportion of violent events as percentage of total events in a country, Gini coefficients, so whether inequality is improved or deteriorated in that country, educational levels and female participation in the total workforce. So this constitutes 25% of a pillar. And of course, you've seen how we do business in more than 200 countries. We have information on over 50,000 companies, and we take risk quite a number of risk decisions over all of these 200 countries in every day. So the fourth pillar of our assessment, which also counts for 25%, is our own payment experience. So if we do experience an increase in claims in a particular country, that is reflected in our assessment of the country as well. So you have access to all of these risk decisions that we make on a daily basis through our country risk assessments as well. And I mentioned earlier that the recovery has been highly synchronized for both countries and sectors. So this is also translated into more upgrades, in fact, no downgrades in our sector risk assessment. Most notably, we did upgrade the ICT sector. I believe we do have some participants from the ICT sector today. The main driver behind this is we've seen a pickup in demand for ICT products, and that's translated into better exports, as a lot of our participants have discussed today. And some of that is seasonal, related to the launch of the iPhone, with most of that supply chain being in Asia. But we do see an increase in demand for products such as smartphones and tablets, and that's of course translated into a more favorable outlook for the sector. And most of the risks still concentrated in some of the sectors that are traditionally more at risk, including construction and metals. Regarding the methodology, this is slightly different to a country risk assessment. It also has 4 pillars. It also includes macro forecasts. It also includes comments from our network of underwriters in all of the countries where we do have a presence. And it also includes our payment experience. So if we have a number of insolvencies in a sector, in a country, this will translate into a lower rating. But we also include a very extensive list of financial indicators, and we can forecast with a model these financial indicators 2 quarters into the future. And that's 25% of the assessment. This includes things such as net profits, revenues, interest cover, and net debt. So all of this is encompassed in this nice-looking chart, but there's a lot of work that goes behind updating these every quarter. And we monitor risks, of course, on a daily basis for the major economies. So going into some of the factors that have underpinned that recovery in the major countries, we see that in the United States, the economy has benefited from full employment. So the line in yellow, I believe, is the UK. We saw like an improvement in conditions, and then that improvement in conditions was derailed by Brexit, so the business cycles deteriorated, employment has increased in the UK. In the United States, we are already at a peak, so this gap between structural unemployment and the unemployment rate is at its peak, and we expect that to continue to decline going forward. Now, President Trump has pledged to do more fiscal stimulus, to invest more in infrastructure, and to cut corporate taxes. That might help in postponing the point at which this business cycle peak comes down. but it by no means can reverse this trend. So we do expect that some of the additional demand from the US to come down in the future. And if President Trump does decide to implement more fiscal stimulus, then it's highly likely that the Fed will try to counteract that decline in the increase in the fiscal deficit by doing more monetary policy tightening in the coming years. The market is now fully pricing in an increase, an interest rate hike in December, and we expect the next interest rate hike to take place in the second quarter of 2018. But this could be potentially faster if fiscal stimulus in the US accelerates. In the Eurozone, we have seen quite a significant level of investment, and that's helped to boost the outlook. But of course, the world today is a very different world to what it was a year ago when we had this conference. A year ago, we were still recovering from the spillovers of the Brexit vote in the UK. And I believe around this time last year, in fact, Tuesday was the 1-year anniversary of Trump's election in the United States. So a number of what we call black swan events did happen, so the market was still grappling with this political risk. And in the European Union, we had an ongoing debate about elections in France, with Le Pen being a strong contender for those, but also the Netherlands and France. So investors were very concerned about potential political developments in the region and decided to postpone any investment decisions. And of course, a lot of those black swan events in the European Union have not materialized. We do not have Le Pen in France, and Germany seems to be on track with Merkel now again in power. So they've sort of moved all of those decisions into the current year, and that's why we've seen a compensation or an increase in investment that was more significant than expected because of this base effect. So low investments last year, a normal level of investments, plus a little bit more because they didn't do investments last year, translating into very high levels of investment, and also very high levels of business confidence, as reflected by the Purchasing Manager Index, which is the graph on the left-hand side. So overall, this has benefited the growth outlook for the European Union, in particular in countries that were hit most badly by the lack of confidence, especially the peripheral countries in the south. But political risk has by no means dissipated in the region. And a lot of that has come to the fore in recent months with, for example, succession talks in Catalonia, protests, and then of course we see some risks around also the recapitalization of Italian banks. So in the chart on the right, you can see that the impact on GDP of political uncertainty of a shock similar to the Brexit, the vote in the UK, and a vote to leave Spain by Catalonia would be the equivalent to a Brexit vote in the UK, is quite significant. In the case of Spain, the impact on GDP is almost minus 1.3%, but overall for the European Union, that could shave off up to 0.3 percentage points of growth next year, and of course that will translate into lower growth into the future. In Asia, the situation remains stable. This is a zoom into our ratings for the region, and you can see that we downgraded a number of economies in 2016. That was related to the fact that we did experience some claims in China. That was after a series of policy missteps in the country, led to a collapse of the stock market in 2015, and also expectations of one-sided depreciation of the renminbi, which translated into many, many months of outflows, and the PBOC, as I mentioned earlier, setting that non-formal 3 trillion floor on FX reserves to try to calm down the markets. So of course, countries that were exposed to that potential deceleration or crash in China through trade channels were downgraded because they were quite exposed. We haven't implemented any further downgrades because we remain cautiously optimistic in the region for a number of reasons. This year is also the 20th anniversary of the Asian financial crisis, by the way. So I just wanted to highlight that a series of indicators have improved quite significantly. In this map, you will see foreign exchange reserves in billions of US dollars. These have improved quite considerably in 2016, which is the bar chart in green, compared to 1996. So in 20 years, FX reserves have increased quite significantly. Please note that the axis for China and Japan is slightly different to the other countries. So this buildup in FX reserves in China is an exception. China has a mercantilist model and a fixed exchange rate regime, which has enabled it to accumulate quite a significant amount of FX reserves. That is by no means the same situation in many of the other countries, but overall, this shows quite an improvement in terms of foreign exchange reserves. And is not only limited to foreign exchange reserves. For example, current account surpluses have become a norm for the region, and that's related to, of course, this buildup in FX reserves as they're part of the equation, but also the fact that many countries now run a trade surplus, and savings have increased for most of the countries in Asia, the only exception being Indonesia, who currently has a current account deficit of about 3% of GDP. The next point is this exposure to foreign debt. So foreign debt to gross national income has declined by an average of 30% for all of the countries in this map. The most notable exception being Malaysia, where foreign debt to national GNI is about 70%. And of course, Malaysia is one of the deeper markets in the region, but it's also very exposed to potential shifts in speculative flows. A lot of that's coming from Singapore. So Malaysia would be a country that's more exposed. But overall, the region as a whole is in a much better shape than it was in 1996. And you can see that that pickup in growth, etc., has led to like an increase in GDP in the region. And in fact, I have here some of the figures for the third quarter of 2017. We saw China slow down only marginally to 6.8%. Singapore grew by 4.6%. That's quite an increase compared to last quarter, and I believe it's the fastest rate in about 7 years. Indonesia was slightly higher at 5.1%. South Korea was 3.6%, and we're expecting Hong Kong tomorrow to come in at around or just under 3.5%. So overall, growth has ticked up quite significantly in 2017. But what is underpinning this recovery? Fiscal stimulus we've touched upon, but I think a much more interesting angle is this pickup in export growth. So in this chart, you will see export growth on a year-to-year basis, meaning comparing June this year with June last year. And just to make things a little bit easier and simpler, I've smoothed this presentation, I smoothed this line to a 3-month moving average. So things have picked up quite significantly in the last couple of months. And a lot of it is related to this demand from developed markets, demand from China that managed to stabilize its economy in this year, the launch of the iPhone and digitalization trends, which have boosted the demand for electronics, but we've also seen quite a significant pickup in commodity prices. Now, this is exports in value terms, so you can export the same volume of steel, but if the price of steel has gone up, then your exports are going to seem like they've increased, even though demand is the same. So this chart shows commodity prices in 2017. We've indexed it, so anything above the 100 mark has increased, anything below the 100 mark has decreased. And we see performance of especially metals at the top of the chart, led by steel prices. But arguably, some of this improvement is related to demand-side factors. So China has done quite a lot of fiscal stimulus. Infrastructure investments as a percentage of total fixed asset investments in the country are now at the highest that they've been since the country launched this huge 4 trillion stimulus package in 2008 to try to mitigate the negative effects of the global financial crisis. So they are doing quite a lot of fiscal stimulus, especially infrastructure, that's helping demand, but most significantly, there's been a series of supply-side factors that have propped up prices. They've shut down capacity, and with less demand comes an increase in prices, but that closure is not permanent. And so we don't see that increase in exports to be sustainable in the future. I talked about China and how they've done some closures to steel capacity. I've mentioned this briefly in the panel earlier. I didn't want to give away too many of my cues for this presentation, but you can see that this optimism that we've seen recently for the Chinese economy is unwarranted. The long-term trend is still towards a deceleration. We expect growth to come in at 6.5% next year, and then taper to around 6% for the remainder of up to 2020. But the fact that they've been doing quite a lot of fiscal stimulus and managed to engineer this pickup in metal prices, which, by the way, are very correlated with industrial profits. So you see higher valuations in metal prices and other sectors in China, and this is related to the better profit performance, but there's a direct link to metal prices. So there has been overperformance in terms of GDP, but no terrible performance in terms of consumer price inflation, and more importantly, total social financing, which is a measure of credit in the economy, has overshot the target by a lot. So the target for this year was 12%, but we can see that it's performed at 16% YTD. So there's been quite a significant increase in credit growth, and of course that's fueling what many investors and rating agencies consider to be a very unhealthy corporate debt bubble. So in this chart you will see that corporate debt accounts for already about 160% of Chinese GDP. That's very high by international standards. And there are some implications, negative implications associated with this buildup in debt. First of all, the increase in non-performing loans in banks. Now the official figures are 1.74%, but they've been 1.74% for the last 5 years or more, I believe. So there's some, I'm highly skeptical about that number. I think other estimates point towards 5 to 10%. That's more likely given the current conditions. And of course, if you have high non-performing loans, you have the tendency to loan less, and you also have worsening financials for certain sectors. Moreover, if you have an increase in debt, you have higher costs of debt service, which of course could translate into some defaults in the future. Now, what has the government done to try to curb these financial vulnerabilities? On the right-hand side, I will start with the right, you can see that they've actually implemented measures to try to lower housing prices in the region. In fact, the housing bubble accounts for 30% of Chinese GDP, directly and indirectly. The only reason why this decline in Tier 1 prices has not reflected in the real economy yet is because Tier 2 prices, so smaller cities, not including Shanghai, Shenzhen, and Beijing, are continuing to increase, and the government is doing quite a lot of fiscal stimulus on the infrastructure front. So that's helped to cushion this decline in housing prices. But they won't continue to do fiscal stimulus at the current pace, and they will start targeting prices in Tier 2 cities as well, so that will bring the economy down. Moreover, a point that I mentioned before, nominal GDP growth has been quite high at about 12%, and that's made it easier for companies to reduce debt. But credit growth has been much faster than GDP. The line in dark blue shows outstanding credit on a YOY basis, and the gray line shows nominal GDP. So we see how nominal GDP actually caught up with outstanding credit, and it started to worsen again. So it's highly unlikely that growth alone will be enough to stabilize or reduce corporate debt levels. Not only because the real GDP is not growing fast, but also there are questions surrounding that reflationary story in China, because most of that is related to metal prices. So the only two ways forward is to continue to maintain an acceptable level of growth, of course, containing risk via macroprudential policies, and we saw the PBOC just announce the creation of a big body to try to curtail some of the macroprudential risks. And third is to allow more defaults and get rid of the implicit guarantees. If we see an increase in defaults, where will most of these defaults take place? And the answer to this is wherever the stress in debt service is higher. So in this chart, we are showing EBITDA over interest expense, or the proportion of companies that have a ratio, or interest cover ratio below 1, meaning that they have quite high stress in their debt service. And we can see that, not surprisingly, most of the sectors that were under pressure a few years ago remain under pressure, including metals, energy, chemicals, and construction. This correlates, by the way, with our sector risk assessments, which can be seen on the last bar in this chart. And it's also related to the results of an annual payment survey that we do across Asia. We reach out to over 3,000 companies and we ask them about their payment experience. And not surprisingly, we saw that some of the respondents that had the highest proportion of their revenues tied up in unpaid amounts were in problematic sectors such as construction and metals, whereas some of the respondents claiming that they had the least amount of revenue or even no revenue tied up in ultra-long unpaid overdue amounts were some of the sectors that are performing better and that we rate better in our barometer, including textile, paper, retail, pharma, and ICT. So the bottom line is that the only way for China to escape this indebtedness is to continue to forge ahead with some of the structural reforms that were mentioned by some of my colleagues earlier. And this will inevitably translate into a pickup in defaults. Just to give you an example, corporate bond defaults in China, although they remain a very small proportion of China's huge corporate bond market, have increased quite significantly in 2016 and 2017, and we expect this pace to pick up even more in 2018 as China tries to address the corporate debt problem. Just 2 more slides. Corporate debt and this problem surrounding debt accumulation is by no means only a Chinese problem. We've seen corporate debt levels increase throughout Asia. And another dimension is household debt levels. So this chart shows the change in household debt levels between 2007 and 2015. Globally, it's using figures by the IMF, and we can see that the countries that have experienced the largest increase in household debt are located in Asia, and these include Thailand, Malaysia, China, Australia, Korea, and Hong Kong. So these economies are exposed on the corporate front, meaning that if there's an increase in borrowing costs, corporates will struggle to pay back their debt, potentially invest less, and also it will lead to higher defaults. But households will also struggle with their debt repayments, and a lot of their debt is tied up to the housing sector, of course, so it's a double negative spiral. And they will consume less as a result. So the region is exposed through their increase in debt to a potential correction in borrowing costs and global liquidity. And just to wrap everything up, we have discussed all of the financial vulnerabilities, and despite these financial vulnerabilities, valuations remain over the roof in a lot of the countries in the world, including Asia. In this chart, you will see the S&P index over here. And it's very high, and it's quite difficult to explain these very high valuations given the uncertainties, and coupled with historically low levels of volatility. Despite, we have a North Korean nuclear threat, and despite we have political risk in other countries in the region. So what, in our opinion, is taking place is that an extension of policy accommodation by key central banks has intervened with traditional signaling mechanisms, such as the credit default swap, etc. And they no longer have predictive ability or the ability to foretell. I mean, it's very hard to foretell when a crisis will take place, but with this excess liquidity in the system, it's becoming even harder, and investors have become complacent. And in the context of a more interconnected global economy, if another black swan takes place, then the impact will be felt much more strongly, and Asia will be no different to other regions in the world. Thank you so much for your time today.